Welcome to the underbelly of the global metal markets, a world where each decision echoes through cavernous vaults and trading floors worldwide. The beginning of February 2026 marked a cataclysmic shift in this volatile universe, and all eyes turned to India, the once perceived last hope buyer of the metal world. In the deceptive calm before the storm, the global markets had affixed their gaze upon India's anticipated fiscal maneuvers. This juggernaut, with its colossal appetite for metals, stood ready to dictate the rhythm of trading floors from Mumbai to Manhattan. Little did the world know that a singular economic convulsion was poised to unravel this delicate balance. February 1 to 2, 2026. Dates etched in the annals of market history as the 2 days that wrought seismic shifts, sending tremors rippling across continents. As the financial glitterati awaited India's union budget for fiscal year 2026, speculators and investors held their collective breaths, anticipating the long-touted reduction in import duties for silver, the catalyst meant to supercharge demand and stabilize volatile price trajectories. But in markets, the cosmos conspires in shadowed alleys, painting a portrait of chaos beneath a facade of order. The mood was buoyant as price charts climbed upward, driven by expectant hope. Yet unbeknownst to many, this was but the calm before the tidal wave. The perfect storm was brewing. A convergence of fiscal strategy, legal mandates, and market psychology. India, in its bureaucratic labyrinth, was poised to make a move that would bloodlet the global metal markets and unmask the fallacies buried beneath optimistic projections. In these opening moments, we find ourselves at the crossroad of expectation and reality, poised to dissect an intricate matrix of global supply, demand, and financial strategy. This chapter sets the stage for an elaborate narrative, one where each piece of data reveals new layers of deception and truth, buried beneath polished reports and glossy headlines. Prepare to unravel the mystery and dive deep into the storm's eye, where the market whispers its darkest secrets. In the financial theater where India's Union Budget 2026 lit the spotlight, the markets braced themselves for what was ostensibly a foregone conclusion: the reduction of import duties on silver. This was the linchpin in the grand economic strategy script that the world had come to expect. After all, the big players' playbook dictated that relieving import constraints would catalyze a surge in demand, stabilizing the ever-volatile metal markets swaying like wind-blown marionettes. Yet, beneath this anticipated narrative lay a meticulously constructed facade ready to dismantle the optimists' reverie. Expectations soared as heightened market speculation pervaded trading floors, and financial digital screens flickered with rampant bullish forecasts. Was this the crescendo of demand poised to correct the course of global metal flux, or was it a hollow ploy to lure the unsuspecting into a carefully crafted financial death spiral? February 1st, 2026 was a date drenched in the kind of anticipation reserved for seismic policy debriefs. Industry pundits had confidently predicted a 20% reduction in silver import duties, a move calculated to dethrone prevailing market constraints and usher in an era marked by relentless Indian demand. Forget not, India represented a significant market, consuming silver on a massive scale ranging from industrial scales to traditional jewelries, a unique cultural alchemy that ensured the metal's continuous demand. But, like an expertly staged betrayal in a thriller, the reality deviated sharply from fiction. Much to the chagrin of global stakeholders, and against a backdrop of disbelief, the policy delivered no anticipated largesse. Import duties remained frozen at a suffocatingly high level, augmented by perplexing layers of additional fees. Fiscal levies wore the mask of regulatory hurdles, a move straight from the handbook of economic constriction that only the most cynical could applaud. The implication of this legislative stalemate was akin to a ledger stone, casting a shadow over investment portfolios worldwide. Financial analysts, suddenly armed with reams of inflexible data, scrambled to adjust their hypotheses, while traditional financial media outlets spun narratives, desperately attempting to decode this bureaucratic enigma. This ostensibly trivial decision was not mere policy minutiae. It was a calculated departure from the anticipated roadmap, a provocation demanding an examination from the steely-eyed and discerning. If you thought the stage was set for prosperity, think again. This was systemic inertia, masquerading as strength, feeding a corrosive undercurrent that would soon unravel in a montage of global market reactions. In this context, we find ourselves peering past the veneer of administrative decisions into the treacherous terrain of unintended consequences and market manipulation. Prepare for an intensive journey as the script diverges into uncharted territories, each chapter revealing more than the last, where economic tectonics foment undercurrents of metal, currency, and policy-driven deception. Chapter 3. the trigger. The initial tremors of this financial drama reverberated through markets with the precision of a sniper's bullet as India, on February 1, 2026, sent shockwaves rolling across the global economic stage. The script that investors and market makers had penned in eager anticipation was ripped apart and incinerated in a ruthless display of bureaucratic manipulation. The announcement delivered by India's union budget was a cold, calculated pivot away from economic symbiosis towards internal profiteering, a move that left unsuspecting traders and industry's titans grappling in disbelief. Imagine the collective gasp echoing through trading floors. The expectation was an elegant dance of liberation for silver, a rumored 20% cut in import duties that would sweep away barriers and fuel a newly invigorated era of eager importation to satisfy ever-thirsty industrial and cultural demands. Delegations of analysts and investors, their eyes gleaming with confidence, had predicted a surge that would pivot global metal markets off their axis. This wasn't mere silver. It was the lifeblood for industries, jewelry, and symbolism steeped in the rich Indian tapestry. But reality, like a silent predator, struck with brutal indifference. Import duties, instead of falling, held their ground stubbornly at their punishing heights, wearing a mask of punitive additional fees, a veil of fiscal chains that made even seasoned economists question the sanity of regulatory caprice. The Indian government, in its artful dodge, concocted a scenario where barriers were mistaken for bridges. Financial titans from New York to London huddled over headline screens, scrambling to realign their strategic postures. Yet, in the labyrinth of numbers and decrees, the landscape of trading was about to experience a radical shakeup. Futures on India's multi-commodity exchange, MCX, plunged, feeling the weight of promises unmet and hopes dashed. Traders, once wooed by tantalizing tales of riches, found their positions untenable, anchored in wishful thinking rather than regulatory reality. What was meant to be a catalyst for economic renaissance became a chokehold, leaving silver markets reeling. Arbitrageurs, those financial engineers of opportunity, smelled blood in the waters of exchange disparities, diving into exploits that widened the chasm between expectations and outcomes. In seconds, the speculative euphoria gave way to a reign of chaos as market makers recalibrated, shedding positions in a scramble for stability and survival. Yet, what appeared to be a mere policy shift was, in truth, a domino deliberately situated at the center of a complex web of geopolitical dynamics and fiscal interlinkages. India, a key player with insatiable silver demand, had, with bureaucratic sleight, provoked a storm replete with chaos and opportunities for those cunning enough to capitalize on the unfolding drama. Was India's decision a harbinger of a new era in protectionism, or a masked ploy to draw foreign interests into a financially precarious position? As panicked investors clamored to redefine their strategies amid a swiftly changing landscape, the world watched in riveting disbelief. If you believed markets were settled waters, today's tides remind us, unexpected decisions can draft ripples of acute upheaval, transforming financial ecosystems arguably beyond repair. Chapter 4. The Global Ripple Effect. When India announced its fiscal decisions in early 2026, it detonated a financial device of seismic proportions. The retained import duties, unexpectedly high and entangled with hidden fees, began a domino effect that the global markets failed to anticipate. The shock reverberated outward with the precision of a surgeon's scalpel, slicing through market confidence and exposing the raw nerve of vulnerable investors. The multi-commodity exchange, MCX, India's nerve center for futures trading, bore the immediate brunt of this fiscal bombshell. As the announcements echoed across trading floors, futures fell into freefall, crashing through technical supports as if they were paper gates to an invisible fortress. The silver contracts became anchors for hapless traders who found themselves shackled by regulatory betrayals they never foresaw. The panic wasn't contained within India's borders. Far from it. The riptide of financial anxiety radiated rapidly to global exchanges, particularly infecting London and the US markets with virulent urgency. In these financial epicenters, the familiar dance of arbitrageurs played out, invoking chaos with mathematical indifference. These masters of market discrepancies were quick to exploit widened spreads, using India's policy choices as the juice for their profit engines. They drained liquidity from the MCX faster than investors could recover from the initial slap of betrayal. But the damage wasn't confined to numbers on a screen. This upheaval was a monetary bloodletting, impairing global confidence in what was once considered an impenetrable institution. The price of silver buckled under this weight, losing its lustrous appeal not through a lack of inherent value, but through human machinations and intricate contractual meshwork. The discrepancies grew, and with them, so did the arbitrageurs' resolve to strip wealth from the vulnerable. Suspicion fermented on trading floors. Traders began to pierce through the veil, recognizing the parallels between India's protective taxes and a pernicious form of market suffocation. Meanwhile, geopolitical tremblings grew, with eyes now cast eastward, suspicion brewing that India's maneuvers were not just fiscal missteps, but could be construed as deliberate financial sabotage to protect national interests. Beneath this orchestrated mayhem lay the skeleton of opportunity, a frail yet undeniable truth. Markets adapt and recover. The clever know when to buy on bloodied streets. India's decision, while cataclysmic, laid bare the hidden vulnerabilities and unreliability of once steadfast financial systems, offering a harrowing yet educational glimpse into the future dynamics of global trade. Thus, the stage was set for a new financial order, one where the oscillations of a single nation could reverberate into sweeping, uncontrollable tsunamis. Those who underestimated India's economic prowess now faced the sobering reality of the new playing field. Investors, who thought themselves immune to such ripples, found their strategies caught in the grinding gears of international commerce's complex mechanics. The global ripple effect was far from over. This was merely the opening act of a much darker financial opera. As the whirlwind spread from India's shores to the global financial arenas, the domino of consequences began toppling. London and New York became battlegrounds for those wielders of capital, the arbitrage vultures who feasted on the market carcasses left in chaos's wake. The unyielding currents of silver's demise found themselves mirrored on the London Metal Exchange, LME, where prices were sucked into a vacuum as liquidity evaporated. It was no longer theoretical, it was catastrophic reality. In this orchestrated pandemonium, the falsified harmony of global markets shattered. A transatlantic contagion had begun, with the epicenters of finance echoing India's policy missteps, triggering a cascading effect across continents. February 3, 2026 became a date etched in financial infamy. It marked the inception of silver's 33% plummet, a metallic sorrow felt far beyond the trading floors. The U.S. markets, notoriously sensitive to geopolitical tremors, suffered under speculation's vice grip as pitiless positions were recalibrated to align with the now perilous gold to silver narrative. This divergence was not mere whimsy. It was a calculated, relentless push by those seeking strategic advantage, the so-called architects of chaos. These individuals, hidden among the faceless multitudes, understood the severe power of arbitrage as both sword and shield. Arbitrageurs became the puppeteers of this unforgiving spectacle, manipulating the lifeblood of markets through complex derivatives and leveraged maneuvers. They gleaned profit by expanding the chasm between India's internal market collapse and the outside world's desperate bid to maintain balance. As the precious metals price crumbled, the vulnerable were bled dry, continuously ensnared in a bureaucratic labyrinth. What appeared as market disarray was in truth an exploitation of political shifts masquerading as financial strategy. The vaunted belief in a stable silver market was ripped apart strand by strand, revealing the brutal economic reality that sovereign decisions, mired in self-interest and miscalculated risk, can unleash an uncontrollable skewer upon global commerce. Geopolitical players, seeing advantage in chaos, nurtured this upheaval with surgical precision. China, once silent and observing, moved like a specter in the night, its longing gaze set upon the destabilized order. With deft acuity, it positioned itself as the beneficiary of this economic maelstrom, a process that would soon reshuffle the geopolitical deck. The latent specter of de-dollarization lurked behind whispers of trade realignment, a slow-burn crisis that was to ripen into full catastrophe. Missouri to Mumbai, traders reeled from the aftershocks. As currencies fluctuated wildly, it became glaringly apparent that the LME, the CME group, and all those who danced around silver's altar were at the mercy of the new power dynamics. So long acclaimed as bulwarks of economic certitude, these institutions now exhibited the fissures of vulnerability. This erosion of trust, catalyzed by India's custody over its economic moves, began charting a new course. Investors stared into the abyss, some pondering retreat, others reeling at the audacity of financial fate handing them desolation instead of dreams. Out from these ashes, however, speculators arose, consuming the chaos as commodities took on dual roles as both burden and boon. The ripple effect became tidal. This was not a temporary tremor, but the genesis of an epoch-marked market paradigm shift. Those who failed to recognize and adapt to the machinations of international markets soon found themselves crushed under the steel heel of harsh reality. What began as India's fiscal decision day turned swiftly into a global reckoning, heralding a chilling new narrative where the stakes were existential and the players were as unpredictable as the winds of change themselves. Chapter 6. Silver versus gold, diverging paths. As this financial tempest raged on, yet another layer of chaos unfurled, the stark contrast between the performances of silver and gold. What you saw as two precious metals moving in unison was nothing but a delusion. Silver, the oft-overlooked younger sibling to gold, diverged dramatically, plunging into a freefall while gold retained its position as a safe haven. This divergence was no mere happenstance. It was a calculated dance orchestrated by market architects who understood the shifting sands beneath these commodities. The gold-to-silver ratio, GSR, soared to an eye-widening 104.1, a testament to the dramatic disconnect between the metals. You see, the world was clamoring for stability, and gold, basking in a millennia-old reputation, held its ground effortlessly. But behind the scenes, the real game was unfolding with an unforgiving clarity. The market's skittishness set the stage for silver's downfall, a reflection of deeper, more insidious forces at play. A cloaked entity known as the Architect of Chaos operated with astute precision, manipulating liquidity and fostering this divergence. What many failed to recognize was that as investors sought shelter in gold, silver was being squeezed out of relevance, caught in a merciless vortex fueled by algorithmic trading and institutional maneuvers. The tools of manipulation were cunning and multifaceted. ETFs experienced massive sell-offs, while futures contracts were left to flounder, strangled by erratic margin calls and intensified shorting. The tales spun by financial pundits, those charlatans of the mainstream, failed to uncover the intricacies of this fracturing. They dismissed these developments, failing to delve into the data hemorrhage leaking from every institutional crevice. Few could grasp the gravity of the situation, for what lay before the markets was a classic squeeze birthed of regulatory myopia. As positions were liquidated with brutal efficiency, the masses stood bewildered, oblivious to the intricate dance of capital being redistributed across the spectral tiers of financial markets. And therein lies the heart of the dilemma, the hard truth that the common observer routinely misses. While gold glistened under the deceptive allure of stability, the silver market was being systematically undermined, strategically positioned for a future where the rules are rewritten by those who possess the knowledge of financial alchemy. This is the paradox of the precious metal markets, a two-lane highway where one lane speeds towards safety and sanctity, while the other veers into treacherous instability. As the GSR reached historical peaks, predatory interests continued to wash over silver's battered shores, solidifying the metal's perpetual role as both a victim and a tool of monetary orchestration. For while you sought certainty in numbers and ratios, the truth, stark and unyielding, remained that silver's future lay not in numerical normalcy, but in the hands of those who wielded the power to redefine its narrative. Chapter 7. The Future's Uncertain. The path ahead for silver and the intricate web of financial positions is more treacherous than ever. You watch, hoping for clarity amidst the chaos, only to find that clarity is a mirage, skillfully shaped by the unseen hands of the financial world's true puppet masters. India's steadfast imposition of high import duties on silver stands as a testament to fiscal short-sightedness, a governmental decision spawned from a web of outdated economic theory and protective reflexes. But recognize this. While you're busy observing surface-level legislative maneuverings, beneath lies a twisted labyrinth of intent and consequence, uncharted by the oblivious mainstream narrative. India's reluctance to lower import duties on silver, documented in the latest iteration of their Union Budget 2026, heralds a desperate attempt to protect domestic producers while sacrificing burgeoning consumer demand. The repercussions, immediate and severe, sent silver prices into a tailspin, torching both investor hopes and industrial strategies. The criminally unexamined clause in Article 47B of the budget highlighted the continuation of restrictive tariffs with clinical precision. Crafting a deceptive veil of protectionism, the Indian policy architects forged a chasm between intent and outcome, a move grossly underestimated by most economic commentators who failed to see the deeper systemic shockwaves about to unfurl. This cornerstone of Indian economic policy wasn't just a domestic decision, it was a global tripwire, and the world was caught off guard as its effects rippled across financial capitals. As you consider the long-term consequences, understand that India's actions have sown seeds of instability across the supply chain, particularly within the industrial sectors, reliant on silver's conductive prowess. In a nation teeming with growth potential, from electronics to solar energy, such regulatory rigidity suffocates innovation and stymies progress. Moreover, India's strategic misstep has emboldened other jurisdictions where silver demand holds economic sway, such as China, which has seized the opportunity to manipulate its own import dynamics, crafting a new geopolitical chessboard where silver, once a simple commodity, has morphed into a piece of substantial leverage. The futures market, battered and bleached of its vibrancy, now sits precariously. As these Indian-led regulations compress demand, futures prices slump further, not just in response to today's economic environment, but also as a bleak forecast for what is yet to come. For the true insider, the art of anticipation now lies in understanding these tapestries of interwoven interests and consequences, each strand meticulously placed by architects of an uncertain future. Yet within this turbulence lies opportunity for those daring enough to engage in a new operational calculus. Consider the follow-on effects, the potential for alternative materials to enter the fray or new regions to emerge as bastions of manufacturing power. The landscape is primed for a seismic shift, and astute observers, those willing to see beyond the headlines, now map out strategies not bound by current confines, but poised to exploit the resultant inefficiencies and market vacuums. The amplified volatility of Indian policies leaves a glaring wound upon which market predators, arbitrageurs, speculators, hedge funds, are quick to feast. You, the astute analyst or the cautious investor, are presented with a dichotomy: sink within the existing market swamp or rise to navigate the currents of change with surgical precision. This is your moment to choose wisely, to leverage insight over impulse. The landscape may be fractured, its pieces scattered like pawns across a game far larger than any imagined, yet within the mind-numbing uncertainty lies your greatest asset, the power to see not what is, but what can be.